Today is Monday, November the 7th, and this is the ADM Investor Services Weekly Market Kickoff. Please note that the views and opinions expressed here today are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or ADM. Today's guests are Steve Freed, ADMIS Vice President of Grain Research, and Alan Bush, ADMIS Senior Financial Economist. Starting with the grains today, Steve, what's the latest on China COVID policy and the impact on grain prices?
On Friday, the president of China, Xi, announced that they will continue to have strict COVID policy. There were rumors last week that maybe they might relax it, but the number of cases has jumped over 7,000, and they'll continue to do this lockdown, which is slowing their economy, which is slowing their imports of raw materials, which is bearish commodities. So the thought process is that they'll continue to have the zero policy through and into 2023 until 70% of their population is vaccinated. And then they could start relaxing some of the policies. And initially started in Hong Kong, the rumors, because they're no longer penalizing airplane companies who bring passengers in with COVID.
Steve, another issue affecting the world order of grain, obviously, is the war in Ukraine. What is the latest on the Ukraine export corridor deal and its impact on grain prices?
Late last week, Putin made a U-turn and said that the shipments could continue. So we're just kind of watching to see what happens now. But on the G20 meeting, he's going to lay out what he thinks is policy. He wants one of their main banks to be reduce sanctions on so they could use to ship grain and fertilizer. And I think the UN would like for that to happen so that there could be more grain and fertilizer in the world available to bring prices down. I think that there's also a feeling that if this bank is available to allow exports, then that probably will hint that Russia will extend the corridor deal after the November 19th deadline.
Let's hope so. Finally, Steve, please give our viewers your current technical picture on the grain markets.
Well, soybean market has been trading pretty much between, let's say, 1360 and 1450 since early July. It's tough for the market to break below that 1350 area because of strong crush demands here in the United States, huge crush margins, and soybean oil looking to be a possible alternative to diesel fuel this winter with the B100. On the other hand, it's hard to trade over 1450 because our export demand looks to be declining. Especially if South America has record crops. And our weather guy feels that La Nina goes away, South America will have better weather. Over the corn market, kind of the same with D's corn trading sideways, mostly between $6.60 and $7 since early August. Again, it's tough when you have domestic prices basis to crushers and to feeders at record high levels versus the record low Mississippi River levels having near record low basis levels for exports. We'll see what the government has to say this week as far as a report, but expecting to see a little bit smaller crop, but maybe lower exports and a higher carryout, which could take us out of this lower end of the trading range. And finally, in wheat, I think the market is really having struggles right now, especially in Kansas City, in breaking out of the let's say $9, $10 trading range. We're right at the middle of that price range. We're seeing an uptick today, maybe because of dry weather in Argentina, low quality in Australia, the fact that Egypt is tendering for some wheat. Most of the world buyers are short and need to buy wheat. Plus, there's no rain forecasted for the U.S. Southern Plains, which is last week, hard red winter wheat crop was rated at the lowest on record.
Steve, what about the low levels of water in the Mississippi right now? I mean, is that affecting, barge traffic? It must be. And if what does that look like as we enter harvest here and we need to move a lot of grain through there?
Well, prior to this weekend, barge freight was record high, and that moved into higher rail rates and freight because more grain had to be moved by a rail and higher truck rates. Over the weekend, we got some rains across parts of the Midwest, and there's going to be more rain across the northern part of the Mississippi River. So water levels are coming up a little bit. Barge freight collapsed, but after this rain event, there's no rain. And so what this is doing is putting a lot of burden on the export market where you have sales that you can't get barges to that point. Also, it backs up grain to the farmer. He has no interest selling grain right now, but markets are in a carry, and they're suggesting the farmer store this grain until the river system improves.
Thank you. Alan, turning to the stock index futures, what is the seasonal tendency for stock index futures after midterm elections? Tomorrow's election day.
Okay, exactly. Since 1950, the S&P has historically outperformed in the 12-month period after the midterm elections, and that average return is a bit over 16%. Now, there are a lot of analysts that don't think that will be the case again this year, with the Fed being on a path of raising rates in December and into next year. But I'm inclined to believe the seasonal will prevail this time around, despite the hawkish Fed. So I would look for gains once the midterms are over in the indices, and I think the seasonal will work this year.
So, setting the election aside, Alan, and looking at the week ahead of us, what economic reports this week have the most market moving potential?
Okay, well, first of all, today we have consumer credit, and that's a measure of how much consumers are needing to borrow on their credit cards. Right now, that estimate is for up 32 billion. My expectation is that it might be higher than that. Also, then on Thursday, we'll have the October Consumer Price Index guessed at up 0.7%, and that would be up 8% annualized. And then on Friday, we'll have the November Consumer Sentiment Index guessed at 59.6.
Alan, U.S. dollar has underperformed over the last 2 months. Why, and do you think this will continue?
Okay, first of all, the dollar peaked on September 28th. That was a bit after the Fed raised rates by 75 basis points. However, the dollar very much underperforming since then. In fact, not making a new high, even though the Fed at its most recent meeting raised rates by 75 basis points. So I think what the dollar is saying is that traders and analysts believe the Fed may not be quite so hawkish going forward. In fact, now it's looking more like the Fed will raise by 50 basis points at the December meeting and not 75 basis points. So with that in mind and the underperformance of the dollar on news, I think the dollar will continue to decline probably for the balance of this year.
Thank you both. Remember, the views and opinions expressed today on this video are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or ADM. If you'd like more information about our brokerage services, would like to speak to one of our experts about managing your risks, or would like to open a trading account, please visit www.admis.com.